Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Detrick, and I'm joined by my co-host, Sonu Varghese. Cutting through the noise in 30 minutes each week with Ryan Detrick, Chief Market Strategist, and Sonu Varghese, VP Global Macro Strategist. Taking out the boring and helping investors focus on what really matters. A quick note before we start the show. Investment advisory services offered through CWM LLC, an SEC registered investment advisor. Carson Partners, a division of CWM LLC, is a nationwide partnership of advisors. Sonu, the rumors are true. I went to Waffle House last week, I guess, with my son. My wife was gone. President's Day weekend, took Sebastian down to Charlotte. We went to Waffle House.
Did he get eggs?
Eggs cost 50 cents more. There's a sticker right there on the menu. Remember, I did that. It's one of those like, boom, there it is. The 50 cents more for eggs. And that's what we're going to talk about in episode 123 of Carson's Facts versus Feelings. We titled it, make sure I read it correctly.
Was it 50 cents per egg, or is it like for the whole thing? It's per egg?
It's per egg, yeah, 50 cents per egg. Yeah,
wow.
So like a 3 or 4 egg omelet costs a little more. But episode 123, Eggscellent Inflation or not? See how we did that? Eggscellent. Yes. But it's true. I mean, I went to Waffle House, and I grew up eating Waffle House. People think it's weird, but I've eaten Waffle House sober. I enjoy Waffle House sober. A lot of people are surprised to hear that. I don't know. It was tasty. You have Waffle House in Chicago? I mean, I guess
not
so, right?
nearby.
No?
You know where in the winter, I go down to Naples every now and then. My in-laws have a place. So there are some Waffle Houses there, and I usually make it a point to go at least once during my trip. And it's just me, right? Like, I'll take a book to read, or, you know, I always have my phone with me. But the rest of the family there, what are you doing?
I've been to a lot of Waffle Houses. I've never seen an Indian guy reading a book before. So it would be unique to be at the Waffle House reading.
There you go.
That's funny. That's funny. All right, well, let's get into it, Sonu. So, I mean, literally the time you and I are recording this, I think, we sold off a little, but we're like 0.07% away.
Wow.
7 basis points from an all-time high. Excuse me, on a closing basis on the S&P 500. Who knows? People listen to this, we might be there. A lot of different angles. We want to talk about markets and inflation here in the first 25 minutes or so. Why are we hitting new all-time highs or flirting with it, Sonu? Everyone told me how bad it was going to be. What's going on?
One word, momentum. I mean, all else equal, I mean, you want momentum. We've talked about that. We've had good momentum coming into this market. From December wasn't all that great, yes, granted. But then January, we saw a nice rally, right? And then that picks up into February. I mean, I know the numbers you're going to talk about with Valentine's Day, but that kind of gets to the point of, you start the year with good momentum. The Santa Claus rally didn't hit, but it didn't hit last year either, right?
Exactly.
So, but we have stocks running strong. Even, I know people are talking about breadth and things like that. Maybe it's fallen off a little bit. But over the last 3 months, 6 months, broaden the horizon. Mid caps have done well, right? Small caps to an extent as well. So I think that's what's happening.
So one thing you shared in a daily note that you sent out to our Carson partners. Which one could it be? There's a lot of stuff you share. You pointed out after last week's big rally in tech, all 11 sectors in the S&P 500 are now higher on the year. S&P is up 4% ballpark on average, or for the year. I think it's seven of the 11 groups are up more than the S&P 500 on the year. I mean, yes, if you look at advanced decline lines, I talked before, prefer those to be breaking out to new highs. They're getting really close, and I think it's going to happen, we'll be clear. But to have all 11 sectors up and 7 of them leading and tech's lagging, but it's still up on the year, that's that broadening out theme that you and I have been talking about a long time. People kind of laughed at it and scoffed at it. It's happening. It's happening right before our eyes, right?
No, exactly. And we talked about that, I think, at the beginning of the year on the podcast. We talked about how 2023 was about Mag 7.
It was.
A lot of that 26% return for the S&P 500, a lot of it came from the Mag 7.
Right.
2024, out of 25%, still a lot of it came from the Mag 7, 15 percentage points. But 10 percentage points came from everybody else. That's not nothing, right? You prefer 25 over 15. This year, maybe that proportion widens a little bit and the Mag 7 compresses a little bit. And so, what we are seeing playing out is, exactly that.
No, absolutely, and it's playing out, and we think it can continue. Right, our big theme, one of our big themes, got a couple of big themes: overweight equities. We think the U.S. will still do better than the rest of the world. I know lately we've seen some strength around the rest of the globe, but honestly, that's maybe more breadth. I mean, more market breadth
Right.
to see
Speaking of,
other groups going higher. But I've got a fun one called the Valentine's Day
Oh.
Indicator. So Valentine's Day was obviously on Friday, February 14th.
Did you get something for the wife?
Well, yeah. So she was again out of town, but I did. I got her I got her a purse. She doesn't listen to this podcast, so there's a matching what's it called, wallet that goes with this purse. She gave a very significant hint. Hey, I want this in a text. So okay, that's good. So I ordered the purse, but it also has a matching wallet. She doesn't know that, so that's coming later.
Nice.
It was on delay. And a couple. I got some flowers and some. I think a couple other things. But again, she was out of town. So Gus and I, my youngest son, we had Valentine's Day together. Went to a nice taco place. That was nice. But nice. He was my Valentine this year. But let's see. So Valentine's Day. So when the S&P is up at least 3% for the year on the day of red, the day of love, February 14th. Like it was this year. The rest of the year, this is crazy, but hey, it is what it is. It's happened 32 times, all right? 32 times. You're up at least 3% on Valentine's Day for the year on the S&P. The rest of the year has been higher, 30 out of 32 times. Up, what is the exact number? Almost 14% on average for the rest of the year. That's higher 94% of the time. Every average year. Look at all different years. The rest of the year for Valentine's Day is up about 8% on average, higher about 3 out of 4 times. So this is just another stack, another layer on top of, yes, we don't blindly invest because of the Valentine's Day indicator. We get that. But at the same time, higher 30 out of 32 times. Let me actually, just because I've got in front of me, the 2 times it didn't work. 2011. Okay, U.S. debt downgrade, nearly a bear market in August of 2011. Greek debt crisis. And you might have heard of this one, 1987. Okay, 1987. So every other year, if we're not going to have a Greek debt crisis, not going to have a U.S. debt downgrade, not going to come off of the GFC like we were in 2011, or an 87 scenario, which we don't think we're in at all. I mean, literally, like small caps aren't even hitting all-time highs. Okay, they've hit all-time highs for years. That's not a bubble. Okay, I want to be very clear there. There's one. Yeah, that's it. Just two. Yeah, just 2. So those 2 years. I mean, what do you think?
No, exactly. I think those are both post midterm years, right? which are, I think 2011 and 1987. Okay. It's the year after midterms, right?
There you go.
And then they came in, and I think depending on what Congress is doing, not that the 87 crash happened because of Congress. I mean, or who knows? We can blame Congress for everything.
Well, to this day, we still don't know what. I mean, we still don't know what caused the flash crash. You don't know. But I said this.
Was that 2011 too?
No, that was May 8th, 2010. I believe it was 2000. But a lot of people forget that day. If you watched CNBC all day that day on the flash crash day back in 2010, there were like riots in Greece. So everybody's tensions were higher because you're watching these riots in Greece, and Greece was just under siege. And then whatever happened with the flash crash. But 87, market was up 40% for the year in August, up 500% from the 82 lows. That's a stretch rubber band. Unfortunately, it was a 21% drop in one day. Let's hope it doesn't happen again. I guess we have circuit breakers, so in theory, it wouldn't happen again. But hey, listen. This market's crazy. You never know what's going to happen out there.
Last week,
what do you think?
Speaking of markets, right? Last week, I thought was a nice example of what we wrote in our Outlook, actually, in a very positive way. The positive parts of what we wrote in our Outlook. We wrote that there are opportunities, Fed rate cuts, that's key for markets, I think, in 2025, and tax cuts. Amongst threats, we wrote, tariffs and the strong dollar tied to tariffs as well, but it's also tied to monetary policy, right? Then Thursday, Wednesday, we got a pullback after CPI data. We'll talk about that. But Thursday, we got a big reversal after positive PPI data. We'll get into what PPI is and what CPI did and all of that. But I think it was a nice example of opportunities manifesting and threats pulling back. It's obviously just one day over 1 week, but I think it's quite telling, right? On Thursday morning, that PPI report came out, and that suggested January core PCE, which the Fed follows, is not going to be as hot as core CPI. So it firmly kept on the table the possibility of rate cuts in 2025. Fed funds futures are right now pricing in a 50% chance of a second cut. Okay. Right? And 15% chance of no cuts, right? Week and a half ago, it was closer to 30%. So S&P 500 rallied about 70 basis points on the back of that PPI report, 0.7%. And then later in the day, we got President Trump announcing new tariffs. We'll talk about that too.
Which, by the way, I was supposed to go on CNBC on Thursday. And we had a meeting. Well, kind of. So I was supposed to be on at like 3:30 with Judge, and I saw Trump on there at 3:05, 3:10, 3:15. Like, okay, well, forget it. He's love him or hate him. He's media gold. They're not going to bump not putting me on over the president. And he did stop, and they actually pushed me back. And I had a really good discussion with Judge because I didn't expect to even be on. And we went for like four minutes, and he actually called me Rye. I said, we're making headwind here. He called me Rye. So anyway, I jumped in there. But yes, but President Trump spoke on Thursday, and that helped put some gasoline on that rally.
And he announced new tariffs. He thought, wait a minute, tariffs equals bad for the stock market. But what was interesting, he pushed all these tariffs all the way out to April 1st. And I'll talk about why it's actually August, not April 1st, indicating maybe this is really a negotiation tactic as opposed to something that's really going to be implemented. I mean, how many times can you cry wolf? I don't know, right?
April 1st is April Fool's Day. When I heard that at first during the press conference, I'm listening. They said April 1st. I'm like, you got to be kidding me. Of course it's not real. It's a joke. It's a joke, everybody. They're just doing this. It's all part of the game.
And there you have. I think markets clearly sense that, okay, this is, he's probably crying wolf. We're going to call him on that.
Exactly.
We're going to fade this threat. We got the opportunity of rate cuts. We got the threats of tariffs fading away, and the S&P rallied to gain over 1% on Thursday. I think that was a big reason why we got that rally. But it gets back to, it doesn't mean we're out of the woods or anything like that, right? This stuff could come back next week. We know there are tariffs coming in the EU, but we'll get into reasons why I think this is really positive. This whole thing that kicking the can down the road, right? And it's really August, April 1st notwithstanding.
Well, August 2011 when we had all the debt downgrade and all that volatility. So I don't know, but yeah, so we'll cover that the second half of this conversation today. From a markets point of view, it's interesting. I think we talked about this last week, but a little more to it. The AAII sentiment poll came out. Bears up again, highest since November of 23. You go back in history, early November 23. That was the bottom of that. That correction we had. Then you had the most bears since before that, since the regional bank crisis in March, April of 23, another major bottom. And then before that was the end of the bear market back in November of 22. So when the individual investors are this worried, it can be a sign of, maybe a near-term low. And I get it, Sonu. People say, well, it's the same crowd. Maybe they're a little tech-heavy. Maybe they have NVIDIA and some of those names that were crushed a couple of Mondays ago. Trust me, absolutely. That's probably playing into it. But then you look at what real money's doing. U.S. equity funds and ETFs have seen back-to-back weekly outflows for the first time in 10 months. So that's real money. People are taking money out, right? A couple of Mondays in a row there, we came into tariff worries. We had AI DeepSeek Monday. Things are calmer. Yeah, we didn't have Monday this week. So there we go. It's one way to avoid that. I didn't have a Monday this week. But even last Monday was calmer. But the reality, again, is we're having bigger news. You get volatility. Everyone gets worked up. Everyone watches the news all weekend, myself included, you included. Look at futures when they open on Sunday night. What's going on? I'm not saying panic, but you're getting prepared for the volatility. Everybody sees it. Everybody gets bared up. And literally, we're hitting all-time highs on the S&P 500. I mean, how about that?
Exactly. Yeah. And this is one weekend, a 3-day weekend. I feel tired, though. I mean,
I don't know. What is it? It feels like Friday. It feels like Friday already. It's only Tuesday.
How's it the kids for 3 days? I think that's why I love the kids. But I was tired. It is minus 5 degrees over here in Chicago, by the way.
Really?
Minus 5 degrees. I think it feels even worse than that. But anyway, I'm not. Yeah, it is not pleasant.
You going outside for any reason today?
I just dropped the kids and I'm done.
Yeah. My wife ran upstairs. She goes, "Where's Sebastian's coat?" I'm like, I have no idea where Sebastian. Look at me, like I don't know where half my stuff is. Okay, I don't even know what T-shirt I'm wearing if I look down right now. I have no idea I don't know. So anyway, what I'm getting at though, she's like, I'm just gonna give him your coat. I said, well, okay. So like he took my coat. Apparently it's way too big for him. So now I don't even have a coat today. But you
so you don't have to go outside.
I don't know. I'll bundle up. Although it's not. I mean, it's cold. It's like 15 or something. It's cold. Not quite as cold as Chicago, but still, it is chilly out there. So maybe let's talk about earnings for a second, and then we'll spend about 10 minutes on inflation. Just some high level stuff on earnings. FactSet data. Looking at fourth quarter earnings up 16.9% year over year. At the start of the quarter, it was 11.9%. So, Sonu, if my math is right, that's 5 percentage points better. Usually it's like 2, 3, maybe 4. I mean, so this is even coming in better when you used to. 2 more than I'll let you talk. Revenues come in at 5.2%. Very impressive. 76% of all companies have beaten earnings so far. Only 62% of revenue, a little late. But here's the one that I thought when I looked at the FactSet earnings data, I forget what that's called, Earnings Insight. It's an excellent weekly piece.
Yep.
They pointed out, I didn't know this, but I thought this was really good. 8 of the 11 sectors this earnings season have actually had an increase in year-over-year profit margins. The overall blended profit margin on the S&P is about 12.5%, highest this cycle. But 8 of 11 sectors have higher profit margins now than they did 2 months ago. That is why, along with other reasons, we're hitting all-time highs. Profit margins, revenue, and earnings are all strong. What do you want to add there?
That's a story, right? And, why are profit margins going up? Well, companies have operating leverage. This is something we've touched on repeatedly.
Yep.
It's also at the firm level a sign of productivity, right? Companies are getting better at, squeezing out more margins, even as sales go up. I mean, that is basically what operating leverage is.
Yeah.
I think that's a good story. That's what drives, because if you break down, profits, how do you get profit growth? It's two pieces, right? Sales growth and margin growth, margin expansion. Sales growth, you think, if nominal GDP growth is running 4%, 4 to 5%, that's a pretty good environment for profit growth, generally. And then the margin expansion piece is sort of like the kicker, right? That's the icing on the cake. And companies are in a good position to expand margins.
Some people don't like icing, Sonu. It's crazy to me, but there are some people don't like icing.
I don't like vanilla.
That's true. Yeah,
I like chocolate, but of course, I like chocolate everything.
Yes. So that's good. Let's spend. We've got about 9 minutes. We're gonna do something we've never done on this podcast. We're gonna let it hit pause. I've got a radio interview in like 9 minutes. We're gonna go about another 9 minutes. Let's talk about inflation. You hinted at it. CPI, consumer level, came in quote unquote bad. I know air quotes. Trust me, if you see on the YouTube channel, we're gonna share some charts on inflation data here on the YouTube channel as we're talking about this. Then on Thursday, PPI, good. Its 10-year yield went up. 10-year yield went down. U.S. dollar, by the way, to me, I've been saying this for 3 weeks now. I think it's making a major top. It's structurally breaking down the new yearly lows or new lows this year. I think the dollar's peaking. So talk to me about the difference between the PPI and the CPI here. So,
oh goodness, and I'll add in PCE as well. So CPI is a consumer price index.
Okay.
PPI is a producer price index. PCE is a personal consumption expenditures index. That's the one the Fed follows, right? Consumer price index is basically what consumer price index and personal consumption PCE are kind of trying to measure the same thing. How much a consumer is paying, except CPI measures how much consumers actually pay in the store or for a service, things like that. Whereas PCE measures how much businesses are charging customers and how much businesses are paying in, for customers. For example, medical insurance, right? CPI just measures, how much are we paying, period. There are more complications to that. PCE index gets to, yes, we are paying insurance, but companies are paying out claims as well. Same thing with auto vehicle insurance, right? We pay for insurance. CPI captures that, but PCE also captures all the claims that people get and make.
Remember, I hit a deer back in October, so I know, and I know how long it took. They had like 35 days to do it. They waited until the 34th day to work on my car. I know they did. So I don't know what that's worth.
PCE captures that. CPI didn't, right? CPI just captures how much you pay for your auto insurance. So a lot of differences now. PCE gets a lot of its data from CPI, but PCI gets a whole chunk of data from the PPI data, so producer price index, which is what businesses pay other businesses for goods. It's the easy way to think about it, right? But that's what CPI, PPI, PCE is. All right. And
so,
go ahead.
Excellent. Yeah. So there's a lot there. I mean, we get it. Our friend Tom Lee of our Fundstrat pointed out, at least on CPI, I know you're going to dig in because you've got your own look at this. He said if you look at housing, auto insurance, and used cars, that was 0.37% of the 0.45% month-over-month headline CPI number. In other words, there's just a couple big things that are still why inflation's higher. That's the excess of inflation. I know you've taken some looks and broken down numbers as well. What did you find, along with what Tom said, that there's certain areas that are why inflation is still a little sticky, but we think it'll come back? And PPI was saying that, in essence, some of those things are coming back, right?
So CPI is up 2.7%, right?
Okay. 2.7%
year over year, right? And then you think, where's that excess inflation coming from, right? It's basically two places: owner's equivalent rent, and it's coming from motor vehicle insurance. That's it. Everything else is making a flat to negative contribution to the year over year number. Right. So keep that in mind when everyone says inflation's sticky, the Fed has an inflation problem. The reality is that, out of the 2.7, 2.8, I'm comparing it to where's the excess inflation relative to where we were in 2019, right? December 2019. So it would be one thing if, there was actually something worrying about owner's equivalent rent and motor vehicle insurance, but we know that's lagging data, right? It's playing catch up. The official data is playing catch up to what's actually happening in reality. So that's the overall picture of like year over year inflation. But January, you love this. It was deja vu all over again.
Yogi Berra, there you go. Deja vu all over again. Yes.
Look, January is a very volatile month for inflation data. It's when we've seen that 2022, 23, 24. right? Inflation numbers
Right.
in January came out hot, and and February tends to be hot, so prepare for that, right? February likely is going to be hot too. There are seasonal adjustments, don't capture this. And then January is a time when a lot of firms reset prices at the beginning of the year, right? Like I said, seasonal adjustment help a little bit, but not to completely normalize.
We belong to not one but two gyms because my boys have friends at both gyms, so whatever. I got significant jumps, more than 3% on both my gym memberships last month. So that's that's the real stuff everyone's experiencing. And you're right, it's amazing, but every January everybody's surprised it comes a little hot. Similar to last year, we think it's just a little pop and it'll probably come back. But go ahead, Sonu. Another couple minutes. So we're gonna take a pause.
So headline CPI rose 0.5%, 0.47% month over month, rounded up to 0.5%. Expectations were already high. It was 0.4, right? But we got 0.5. It's been hot. The big drivers, eggs, right? Eggs added. It doesn't seem like the eggs are a tiny part of the CPI basket. Really, like think about how many eggs do you buy a month, right? Relative to your mortgage and rent and, you know, all the other stuff you pay for, right? Eggs is nothing, but eggs added 3 basis points to that, which it does 0.03% out of 0.47% doesn't sound like a lot, but it is, right? It matters. That's because eggs are up 15% month over month. That is massive. It's up 53% year over year due to the avian flu, right? And now it is offset a little bit by the pullback in restaurant prices. That's a good thing. I've talked about that before. But we saw core services slightly hot, core goods, excluding food and energy, slightly on the harder side. I would be worried if there was a broad-based increase across the board, across core goods, core, services as well. But we didn't see that. Core services rose on the back of 3 categories: auto insurance, auto fees, and then some recreational services like movies and concerts, right? That was a big piece. Last year, I think there was a little more to worry about. 2 years ago, there was much more to worry about when it was a broad-based increase. This time, not quite. And I think, you get these random things going on. And then, of course, it's January, right? So that was the story with CPI.
So excellent. So then we'll go to PPI, which again, the core came in 0.3 versus 0.3. Headline a little hot. Our buddy Neil Dutta over at RenMac said, if you look at medical care services, airfare, auto insurance, and portfolio services fees, which is one we've talked about before, those are all showing some improving signs. You had healthcare services flat. You had portfolio management services up only 0.4 from 0.6. So it's trending the right way. And he's got, through the last 3 months, 1.6 annualized, not all that much. And then airfare. CPI at airfare up, for me, my writing,
4.3%.
Yeah, up big. And yet PPI was down. So PPI was down. So I don't know what to make of that. So really, Neil said all non-housing services looked better. And that's why the market rallied and yields dropped and the dollar dropped on Thursday. Sonu, we've got like 1 minute. We got to take a pause. Maybe we'll talk when we come back about what it all means for the Fed. But how do you want to wrap up PPI in 1 minute?
No, PPI, the main 3 data points, as you mentioned, airfare prices, healthcare services, portfolio management services, basically stock prices, all trending in the right direction. So it was a big downside surprise. And for inflation, downside surprise is a good thing, right? So our friends at Employ America estimate using PPI and CPI data that core PCE will rise 0.25% month over month in January. Remember, core CPI increased close to 0.5%. So this is about half that. And that would take core PCE inflation to about between 2.5% and 2.6%. That's a new post-pandemic low. That's well within reach, I think, of the Fed's 2% target. And remember, even that extra 50, 60 basis points coming mostly from lagged housing inflation and stock market outperformance, right? I mean, we want the market to have momentum, don't get me wrong. But if things slow down later, there is an upside on the inflation side, right? And I think, look, like I said, February could still be hot. So we may have to wait till mid-March. But beyond that, I think we see disinflation.
Excellent. Well, listen, this is a facts versus feelings first. We're going to hit pause for a minute. We're going to come back, Sonu. Let's just remember where we are. We're going to talk about what this matters, why this matters for the Fed. We'll talk a little bit about Fed, a little bit about tariffs, and kind of wrap it up. But
and you all don't need to hit pause.
You don't need to hit pause. I got to go talk to Sirius XM. They like me there. So anyway, all right, Sonu, we'll chat soon. And we're back. A facts versus feelings first. I just did a radio interview with Janet Alvarez over at Sirius XM. Go on her with her weekly. So thanks, Janet. Just kind of the timing. We survived. Nice. But Sonu, before I go there, I do want to point something out. Thanks so much for tuning in to our latest episodes. We'd love to hear your thoughts. Drop us a comment or let us know what you think. Your feedback helps us making the show better. Facts versus feelings. That's VS at carsongroup.com. You can also rate the podcast as well, wherever you get this podcast. It helps with those algorithms. We like our ratings.
For sure.
All right, so Sonu, we did kind of stop. We talked about PPI. Maybe you want to add a little more on PPI, but then we really wanted to focus on, okay, inflation this, inflation that. What does it mean for the Fed? The F word in the room, the Fed. Take it away, Sonu. Connect some dots here for everybody.
Look, PPI was basically countered everything CPI did. And then some, because ultimately what matters for the Fed is PCE, core PCE, as I said, from our friends at Employ America, slated to come in between 2.5%, 2.6%. But when you look at that, you think, wait a minute, 50, 60 basis points above the Fed's target. But no, all of that is coming from shelter and, as I said, stock prices, right? This is all, like, that stuff should go away, barring any other surprises. Usually on the energy front, when you talk about inflation, what I worry most about is, in terms of surprises, energy. That's where the real surprise comes. Because the labor market is not a surprise. Labor market is a big piece of it, inflation, but that's never a surprise. We know what that's doing. We get numbers on the labor market month after month after month. We get, the employment cost index and all of that stuff. None of it points to, any sort of inflationary pressure from the labor market. And literally, that's what Powell said last week, too. Right, so Powell is doing a semi-annual speech. I don't know what it's called. Ryan, do you know?
The Humphrey Hawkins, isn't that what it's
Humphrey
called?
Hawkins, yes,
the Humphrey
yes,
Hawkins.
yes,
Humphrey
yes.
Hawkins.
That's what Powell
Humphrey Hawkins dance. I don't know. It's not a dance. It sounds like a dance in high school. I don't know. Humphrey Hawkins dance. I don't know.
Yes. So
could you imagine Powell dancing? By the way, just think for a second. Give the guy a couple beers, couple shots, loosen him up a little bit. He seems like it'd be kind of fun though. He does seem fun.
Of him at a Grateful Dead concert. He's a Grateful Dead fan.
That's true.
So I didn't see a picture of him dancing, but I could see he was kind of jiving there. So
that's what we liked about him. He's not a pure economist. He's not a pure doctor. I think he doesn't have a doctorate. I think he doesn't have a doctorate. I think one of the first Fed since I believe Volcker. I hope I'm right on what I'm saying here. The first time since Volcker we had a. I don't know about Volcker if he was a deadhead or not, but at least first time we had a non-PhD in charge of the Fed.
If you ask Greenspan, Bernanke, Yellen, can I picture them dancing? I don't know. I mean, maybe Yellen doing a waltz. No, I don't know. I don't want to get into trouble here. But Powell, yes, I could see Powell doing a little bit of a jig, moving at the beat a little bit. So, speaking of moving at the beat, see how it.
Yeah, nicely done.
Yeah. So. In front of Congress, the House, Senate, he mostly reiterated what he said after the Fed meeting in late January. We talked about that. The highlight, I think, was that, look, the Fed need not be in a hurry to adjust policy, right? So he did say the Fed funds rate was significantly less restrictive than it had been, implying rates are still restrictive. So that's important, right? So I think there is still a cutting bias as opposed to a hiking bias. And we see that in the probabilities and the Fed funds futures and all of that, right? But he did also point out, look, long-term inflation expectations, quote unquote, appear to be well anchored. And there's some dispute. I see, if I look at inflation expectations, the consumer stuff is just pure noise, right? You ask Democrats one thing, Democrats expect stagflation. You ask Republicans, they expect 0% inflation. Yeah. Well, you're getting 0% inflation only if you get a deep recession. You're not getting 0% inflation. So everyone's all over the place. You look at the New York Fed's consumer survey, which is much better, more robust methodology. That still shows inflation's consistent with the Fed's 2% target, right? And then you look at the market. I think short-term expectations are rising. I think that has to do with tariffs. But you look at longer-term expectations, which is what the Fed cares about. That's, again, consistent with 2% inflation. But see, the most important thing, you're talking about the labor market, right? Powell once again said the labor market, quote unquote, was not a source of significant inflationary pressures. And then I'm thinking, wait a minute, then why are you keeping rates tight? Because monetary policy works through the labor market, right?
Yep.
Technically, he would never admit it directly. They kind of say it. How does it work? It works by raising unemployment. When you raise unemployment, there are less workers spending. You're reducing demand-side pressures on inflation. But as Powell said, if demand-side inflationary pressures are not the problem, like I said, why not cut rates, right? So his argument is we're keeping policy on the tighter side for two reasons. The economy is strong. Inflation looks like it's persistent, right? That, like I said, the good news is there's no hint of I don't think they're even thinking of raising rates. It's all on the other side of it. They're thinking about when they can cut next. And Powell also said they can ease, even more if one of two things happen. We don't wish for this. If the labor market weakens, Bad. That would be bad news. They're cutting based on bad news. I don't think we want that because bad news tends to be bad news. And the other is good news. Inflation falls faster than expected, right?
Okay.
I don't know if it falls faster than expected. Like I said, February, it's going to be maybe on the harder side. You're going to have to wait till March, April, maybe even May to counter the effects of what happened in January and maybe February. So the Fed's biased towards cutting. But honestly, I think after this last week's inflation data, I think they're going to cut. But we may have to wait till June or maybe July. The other thing is they're still worried about policy from the White House.
Sure.
Right?
Sure.
He's more or less admitted it. He said there's considerable uncertainty on the policy front across various areas, trade and tariffs, immigration, regulation or deregulation, fiscal and tax policy, right? So I think that's what, that's why we may not get a May cut. But I don't think that precludes us from getting maybe a June or July cut. I'll put it that way.
Well said there. Great summary of everything. The New York Fed does a survey. It's a survey. I thought this was interesting. The 1-year inflation expectation, the 3-year inflation expectation, and the 5-year inflation expectation all were 3%. I don't know what to make of that, but they're all right about 3%.
And 3% is normal.
No, exactly. That's a good point. It's not like, massive. It's much lower than it was a couple of years ago. And as you mentioned, the University of Michigan has one also, but I think it's significantly skewed by politics. And it came in much higher. But that the New York Fed one, which is maybe a little more neutral as it pertains to politics, came in a little bit better, and that was something people wanted to see. You also have that policy uncertainty index. Honest to goodness, I'm not sure who creates that, but that's like the second highest level ever. I don't know, not a shock. I mean, you got a new president who likes to do some bombastic things. Of course, there's high uncertainty, but over at RINMAC, Jeff DeGraff of RINMAC, he does the T studies and things, and says, hey. When you want to go long the S&P 500 when there's a lot of uncertainty. Why is that? Because that probably means things are scary, there's this and that, but it leads to eventual, I'd hate to say certainty, but little bit of certainty. There's no such thing as certainty.
You'd never have, exactly.
No, how about this? Less uncertainty. Maybe I'll go that route. But that can be a bullish thing. And again, I think that's why we're flirting with all-time highs the time you and I are recording this, even after the scary headlines that we continue to hear and see on trade and tariffs.
And there's a positive opportunity with policy uncertainty, right? Two things. One is rate cuts. It's just, the uncertainty is when we get it. I don't think it's about whether we get it or not, unless we get some crazy, energy surprise on the upside. Okay. But the other uncertainty is actually tax policy, and that's a positive tail opportunity, right? We talked about that in the outlook. Congress is just about getting started. I think it's going to take them a lot of work. It is Congress after all. Nothing gets done very easy, and then the Republicans in the House have barely a 2-3 vote majority. So. Yeah. Everyone's going to want to.
Don't be sick that day if you're a Republican and you want to win, or if you're a Democrat, maybe cough on them a little bit, get them sick.
But the other thing coming up in less than a month is potentially a government shutdown, right? The budget.
Oh God, no! Don't tell me. No, we're not going there. Don't do it. Don't do it to me, Sonu. No.
So that's the next thing they have to do. Congress has to agree on a budget for the next fiscal year, and they kicked the. Remember this? We were talked about in December. They kicked the can down the road. Well, the road is almost here. The road is ending in March 15th, right? So they got to figure that out too. Congress has a lot of work to do, but I think there's a lot of upside potential over there too.
Well, I'll get the data on it, but I think like every president since the 1920s has kicked the can and increased the budget deficit and increased this and increased that. We'll get there when we get there. Let's see what else. I mean, I guess I want to touch on anything else on trade policy. I think we've kind of covered it. Anything else on trade?
Maybe
I want to talk retail sales before we end. I thought that was interesting.
Just a couple of things, a couple of minutes maybe on reciprocal tariffs. I don't know how you reciprocal tariffs. You should talk about that because that was the other thing that happened last week. Right, so somebody asked me.
I think it's reciprocal, right?
Reciprocal.
See, hey, listen, we're winging it, everybody. We don't know half the stuff we're talking about, but we sound like we do.
So somebody has asked me, like, how do you, is this the same thing as you learned in math, reciprocal? I mean, like 1/2, 1/2, reciprocal of that is 2. No, that is not what we're talking about. Reciprocal tariffs simply mean that tariffs imposed, tariffs are imposed on countries based on the rate at which they tariff U.S. goods. That's what the U.S. wants to do, right? Okay. And it will technically only because of that apply to countries that apply higher tariffs on U.S. goods. Say India applies a 20% tariffs on certain U.S. goods, and the U.S. applies only a 1% or 3% tariffs. Right. The U.S. is now going to 20, right? But what happened last week was Trump had already hinted at this, right? But he also wants to account for something called non-tariff barriers, including regulatory requirements, subsidies, exchange rate policies, and even value-added taxes, which I would argue VAT taxes have nothing to do with trade, right? In fact, if I shop in Europe, I get charged a VAT. When I leave Europe, I can ask for a refund on that, right? So even their own goods get taxed, for the value-added tax applies to that. So anyway, what happens is it's not going to increase too much on goods coming from Europe and East Asia, especially places like South Korea. We have a free trade agreement with them, so there's no tariffs, right? Like even Canada and Mexico, free trade agreement. There are not a lot of tariffs here. These countries have a zero tariff rate with the U.S. But then the question is, wait a minute, you have this other 25% tariff threat on Canada and Mexico. How does that fly? It's all a mess. That's what it is. It is a complete mess. And the other thing is reciprocal tariffs are very hard to impose because every single good may have a different tariffs. Every single country may have a different tariff as well on these goods. There's significant technicalities involved in imposing these tariffs. Agencies will have to update tens of thousands of codes for goods, right? So which is why Trump said, I want a study. Remember, it's a study. When you want to kill something, you ask the government to do a study. I want a study done by April 1st, not to mention you talked about April 1st being April Fool's Day. But then it will be August 12th, before the White House Office of Management and Budget, the OMB, has to submit the report, right, to talk about actual implementation. So we have a long way before August.
Gosh.
We may even get a Fed cut before then, right? So I think the long lead time, massive scope, suggests these are just a negotiating thing. And it's, it's not realistic to ask European countries to say, hey, you need to take out your VAT. It doesn't even impact us, in a lot of ways, right? So that's not even, I think, a realistic negotiation stance. But I think the other positive is that, remember, we are worried about what else will Trump announce, right? What are the tariffs? Because they're working on this reciprocal tariff plan, I don't think we get those other tariffs.
Right.
And I think that's what the market sees. Wait a minute. We're talking about the scope of really broad scope of reciprocal tariffs. That, for one thing, it's pushed all the way to August. The other thing is it precludes other announcements of tariffs and things like that. So good news is, I think, good news.
Yeah, great. I mean, that's good stuff, obviously, and it can change in a hurry. We're aware of that. We'll talk about it if it does. But that's some positives on the trade front. The one thing I want to touch on, then maybe wrap it up. Retail sales were down 0.9%. Expected to be down only 0.1. And I saw what's the other one called, Sonu? The control group. Down 0.4. Expected to be up down 0.8. Expected to be up 0.4. According to a survey of Bloomberg economists, that was a 5 sigma event. I didn't have the time to look that up, but that's it shouldn't happen. It shouldn't happen, but it did. And then you think about it, it was really cold. I mean, we were
and we had wildfires too.
We've had more snow on the ground in Cincinnati the wildfires too, but just more snow on the ground. We've had snow on the ground for a month straight. That never happens in Cincinnati. I mean, the weather truly hasn't been good. And I'm not saying it's just because of the weather. We need, what did Master Yoda say? One data point a trend does not make. You need a couple different data points
or three
to get there, or 3 or 4. So this is one that shows the economy's maybe a tad, or the consumer's a tad weak. But you got wildfires in one part of the country. You've got 8 inches of snow on Bourbon Street. That just doesn't happen.
Exactly.
And then you had this big miss. And I think the market is looking past it. I know the media ran with it. The consumers tapped. We just got the updated data, which, by the way, hopefully
consumers been tapped for 3 years.
Yeah, but hopefully you can dive into that. I love when you update every 3 months when they do the Z.1 data.
I have that. Ready
I know
to
it's
go.
coming. But the 1.21 trillion in credit card debt. Anyway, close enough for government work because, like you said, the government kick the can. But there's a lot of debt out there. Yes, media run with that. Oh, the consumers tapped. Look how bad this data was. Obviously, market's looking past it. Did you have a chance to look? I mean, I saw bars and restaurants were up. Only 2 or 3 groups out of 16 were higher. Bars and restaurants. People found a way to go eat and drink in the snow, but in the cold. But what'd you think? So
look, am I worried? No. I mean, these monthly updates. I mean, if I had to guess what's going on, I suspected seasonality. I think there's the wildfires and all of that. Yeah. There's other funky things going on there. But I suspect it is seasonality too. The same issues with inflation data. I think some of that is happening with retail sales as well. And then some of it may have been pushed over to like December is revised up.
That's
right?
a good point. I didn't point that out.
Yeah.
December is revised higher.
Exactly. And then you look at like restaurant and bar sales, right? To your point, last 3 months, November, December, January, running at a 6% annualized pace. I know that's nominal numbers, but still, food inflation's, yes, egg prices are up a lot, but it's not up like, even if you take food inflation, maybe running about 2%, 1.5%, 2% year over year. You take that out, restaurant bar sales are running about 4% in real terms, inflation adjusted. That is very strong, right, by itself. And, 1 month, like you said, doesn't make a trend. We'll see what happens over the next 2 months. Part of it is like, I was already thinking, given everything that's happening, that especially elevated rates, I don't think the consumers, I wasn't too worried. I'm not too worried about the consumer. I shouldn't say I wasn't, right? I'm not too worried about the consumer. I think the labor market is fairly strong, but I don't think we see 3% GDP growth this year. But that's not because the consumers tapped or anything like that, right? Yeah. I didn't change my view because of, what happened in retail sales. That could change the next month. But I think elevated rates create a problem for housing, creates a problem for businesses who want to borrow and things like that. Look, the spread between what a business borrows at, the rate at which they borrow at, and treasuries is very tight. So the credit markets are not sensing a problem, but still the absolute value of the rate at which they borrow is still high, right? So that is, that's a constraint, right? They have to pay more on interest. They have to pay more on borrowing. And that's why I think hopefully the Fed, I think they will reduce rates. We need to see some relief. I think that's the difference between whether we get 2 to 2.5% GDP growth versus 2.5 to 3% GDP growth.
Got it. No, well said there. I found what I was trying to say. If you look at, there's 13 sectors of the, or 13
retail sales,
groups, retail
categories,
sales. Yeah, categories. That's the word I'm looking for. Thank you. 4 out of 13 were up month over month, but year over year. Then I've got 15 of 16. So somehow I've got something wrong. It's either 13 or 16, but apologies. What I've got written in front of me is 15 out of 16 are up year over year. Do you know the only one, Sonu, that's down year over year? That's kind of what I was getting at. The only subsector or category down. Don't look. I see you looking, you cheater. Don't you look?
No, I don't have it. I don't have it in front of me. I have 3 month annual.
Sporting goods. It's sporting goods. I don't know. I mean, which is funny because I mentioned we couldn't find my son's coat. My wife said she's going to run the Dick's later today. So, well, we're helping, apparently going to buy him a coat at Dick's later. So we're going to be helping that.
I did go to Patagonia yesterday, by the way. 2 days ago. I did go and got myself a new coat.
Awesome. Well, all right. So we're at the end of the road. Any final comments? I'll bring us home.
No, I think last week, like I said, going back to, what we talked at the top of this, the first part of this podcast was last week was an example of how opportunities manifest, whether on potential rate cuts still being on the table, tax policy, Congress has started to get moving. It's still going to take time. And then threats fading away. The tariff threat being really kicked down the road. And that was good for markets.
Yeah. No, well said. I mean, I've said before, I didn't think 2025 would be the first year that goes up like every day and has no scary headlines and no volatility, right? And I hope you weren't either, but apparently people were surprised when we had volatility. Apparently people were surprised that there were some negative headlines. Here's a spoiler alert. We're going to have more. We're going to have more volatility. I mean, that's just the way markets work. That's the way bull markets work. We're in a bull market. We've been saying that for 2 years, almost 2.5 years now, practically. We've been saying that for a long time. So let's just remember that. But at the end of the day, we have fun doing these podcasts. We're going to keep doing them. We're going to keep doing it. We got some. We're working on some big guests coming up here sooner than later. So we got some guests on as well. But it's always fun. So listen, everyone. Thank you so much. We've had a lot of good downloads and listens. And check out the YouTube channel and give us some reviews and likes and thumbs up and all that stuff. It helps a lot. And with all that, we'll see everybody next week. Take care, everybody. Stay warm, and we'll see you soon. Thank you. Goodbye. Information provided on Facts versus Feelings with Sonu Varghese and Ryan Detrick are for general information only and are not intended to provide specific advice or recommendations for any individual. The statements and opinions of show guests may not be reflective of CWM LLC or its affiliates. Past performance is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Guests on Facts versus Feelings are not affiliated with CWM LLC.